Good morning, students. A very happy good morning for you and a very important good morning to all of you. Because today is the result of CA Intermediate and CA Final, both. And I get just about to declare in some time, might be till 9 o'clock or etc. So those students who are waiting for their result, all the best from my side to all of you. Those who actually work hard and actually want to be a CA or sincere for this course, I believe that they will clear in this result. So again, a very good morning, Suprabhat, Sasri Akal, Vanakkam, Kencho, etc., etc. Namaskar also to everyone, and a lot of good morning has already been there. That is Komal is good morning, Kiran good morning, Bhumika good morning, Darshan good morning, Sudhanshu Shekhar good morning, Rajiv Kumar good morning, Diksha good morning, Manisha good morning. Okay. So before starting the class, you already knew the guidelines of my class. I always appreciate if you follow that. And the guidelines were just very simple, that you should be focused. Please ask the query related to the topic. We will take all the queries after 30 or 40 minutes of the class. Then important thing, if you want to ask anything in Hindi, you can ask me and I'll answer that question or your query in Hindi. I have uploaded the notes on the portal and I believe you all must have downloaded it. So assignment number 1, 2, 3. I have coded 3 PGBP notes assignment and one is last MCQ, what we discussed in our last lecture on 3rd of July. And I personally believe that you all are working hard for your success. As I always do, let's share a beautiful quote for today's class before starting that. And the quote is by Mr. Abraham Lincoln. We all know him. He is a great leader. And he said a very beautiful thing, that I walk slowly, but I never walk backward. If you read this quote and try to understand it, you can see the beauty of this quote. I walk slowly. That means the progress can be slow or fast. It does not matter, but there should be progress. There should be upgradation in everything. But I never walk back. Even you are walking slowly. You are walking slowly to achieve your goal. But the walk should never be back. For a CA life, for a CA journey, that actually work. This code really work. If you start studying 2 hours a day, then please try to increase that time limit. Should be focused and you should try to increase that limit from 2 to 2.3 hours and then 3 hours, then 4, etc. Depend upon your planning, etc. But you should not walk backward. So it's very important in your personal life as well as time goes, you should mature, you should understand that after even becoming a CA, you should not stop your knowledge. You have to grow your knowledge. So the progress, the increment, the growth, speed does not matter that much until you are growing. So you have to grow. Whenever you read this quote, you understand that it's a very simple line. It's just a very simple line with few words. But technically, it's very strong. So we should all try to walk slowly or fast, but we should not walk backward. So that's a beautiful quote we just discussed. Then moving on to our notes, I asked you a question to solve. I gave you a question in my last session regarding sale of scientific researches. And I asked you that in my next class, I will see how many of you have tried to solve it and get the answer what I was asking for. So I believe some of you must have tried it and some of you must have been solved it. Let's see if anybody has solved it. Okay, somebody start asking query. Good morning, wishes still coming. Sankaran, good morning. Vishwatra, Reddy, good morning. Para, good morning. Aditi, good morning. Dikshita, good morning. Rishita, Kavita, Akshay, Lata, everybody, a very good morning to all of you. Okay, what is the treatment of balancing chart? Darshan is asking, as terminal depreciation is going to be shown in the debit side of a profit and loss account, a trading account, the balancing chart should be shown in the credit side of that profit and loss or trading account. Okay. You are asking your queries, but nobody's answering my question, what I've asked you. Okay. Darshan is asking illustration number 2, depreciation of 78750 would be for 1920 only. Then we have to calculate depreciation for 20 to 23 from the opening WDV, in which depreciation is deducted in the previous year, sir. What is the closing WDV in the current previous year? Illustration number 2. Let me see which illustration you are talking about. In the notes, Darshan, or in the MCQ? Is it an assignment number 1 or 2? Kindly let me know so I can discuss that. Please tell me it is in the notes or in the MCQ, and what illustration you are asking number 2. That is regarding which assignment? I have the notes. Okay. With an assignment, I'll let you know right now. Okay, I guess you are asking illustration number 2 for from the notes. It says the car purchased by Dr. Saman. What is your query? We have discussed that the depreciation for assessment year 23-24, that's 750 will be the depreciation for assessment year 23-24. Okay. And if you reduce it, that balance will be your WDV. Any of you have solved the question I have given you as it's showing on screen regarding the scientific research asset? Okay, Khushi is asking income tax section 35(2) से 4 इस सेक्शन में डेप्रिसिएशन फ्यूचर में कभी नहीं लगेगा एसेट पे अगर लास्ट 3 इयर्स के एक्सपेंसेस राइट ऑफ हो जाते हैं डिडक्शन लेने के बाद यस in any case if the deduction has been claimed on any asset and that deduction is about the whole cost price of that asset, that means if 100% of the cost of that asset has been allowed as deduction in case of any asset, then no depreciation can be claimed in future, whether it's section 35AD or it's section 35. Okay, Darshan was asking the balancing charge treatment. I've explained it. Darshan asking in section 35AD, deduction of capital expenditure is allowed only in the year of starting of business, or it is allowed in subsequent year also. No, whatever capital expenditure you have done till the commencement of business, that is going to be deducted in the year of commencement of business. And any expenditure has been done after commencement of business, you can claim its deduction or you can claim depreciation on that. Both is allowed depending upon the specific situations. Okay, so any one of you try to solve the question I have given you in the last session? I guess not. That's very bad. I asked you that you should try to solve this question, which is regarding the sale of scientific research asset, and might be nobody of you have tried it. So it's not good. Please try to solve it. Let me solve it for you. It's today we are using Microsoft Whiteboard. Okay. So the question was, we have a scientific research asset and it has been sold for 25 lakh rupees. Mr. Kishore Prakash was using a scientific research asset and it was bought rupees 15 lakh rupees in previous year 15-16. I told you then when there is a question regarding sale of scientific research asset, there will be two conditions. Whether it would have been sold without using for other purpose. Without using for other business. So if it is happening that the asset has been sold without using for other business, then I said the minimum of two will be your PGBP income, and that was the net sale consideration, which is in question is 25 lakh rupees, or the cost of the asset which has been allowed as reduction, which was 15 lakh rupees. So in this question, 15 lakh will be your PGBP income, and you need to show it as the credit side of P&L account. Okay. And I also told you that if the selling price exceeding the WDV of the asset, the selling price exceeding the cost of the asset, as in this question, selling price is 25 lakh and cost is 15 lakh. Then we need to calculate capital gain also, which I am not discussing right now because you do not know the provision regarding the capital gain. We have to solve right now what is the PGBP income. So if the asset has been used without using for other business, then the PGBP income will be 15 lakh rupees. I hope it's clear. Now, if it is used for other business also, and then sale. Okay, before moving on to the other business, first of all, the PGBP regarding this business will be 15 lakh. And we need to calculate the PGBP income. And PGBP income in the question has been given, net profit is 5 lakh rupees before claiming depreciation. The block of asset value has been given 10 lakh rupees and the DAP rate is 15%. So if I'll apply 15% DAP on 10 lakh rupees value, that will come 1,50,000. So my business income after claiming depreciation was 3,50,000. And this scientific research asset business income will also going to be the part of my business income. So now the total business income for that previous year will be 18,50,000. That was the answer in case asset is used without using for other business. But if asset has been sold for without using, after using for other business, then in first case, whatever is our WDV, we need to add the cost of the scientific research asset in that block of asset value. WDV is 10 lakh rupees. And I told you, if scientific research asset become the part of this WDV, the cost will always be nil. So the WDV will remain rupees 10 lakh. Now the question says, if this asset has been sold, because in the question it says that this scientific research asset has been sold for rupees 25 lakh rupees. And now WDV was 10 lakh, but the money received exceeding WDV. So the format says that the money received exceeding WDV, then we can deduct only the money received till the amount of WDV. So we cannot deduct 25 lakh, we can only reduce 10 lakh rupees. That will become the WDV nil. So if WDV is nil, then we cannot claim depreciation in this year. So if there is no depreciation, then PGBP income has been given in question 5 lakh rupees before depreciation. And because there is no depreciation, so PGBP income will remain 5 lakh. But in this case, again, we need to calculate the capital gain, but that will be discussed in capital gain chapter. So in first case, the PGBP income will be 18,50,000 because there was depreciation as well as the PGBP as per sale of scientific research asset. But if your scientific research asset become the part of WDV, then there will be no PGBP income if you sold that asset. It will be only capital gain. In this case, there is capital gain as well as PGBP income on sale of asset. But if you use asset in the other business, then there will be only capital gain, no PGBP on sale of asset. And because on sale there is no WDV left, so PGBP income will be only 5 lakh rupees. There will be no depreciation you can claim. Okay. So that is the answer. I hope you understand now. Okay. Whenever you asking question, please refer the question as Khushi is asking, sir, agar Ajit ke case mein answer should 10 lakh. What is Ajit ka case? I don't know what question regarding you are talking. So Bhumika has answered the question rightly. That was 18 lakh 50,000. Bhumika, you wrote 1 lakh 85,000. I guess it's by mistake. So the answer is 18 lakh 50,000 one case and B case 5 lakh. Well done, Bhumika. Okay. So moving on to illustration number 5 in page number 4.222. Let me see what is the illustration you are asking, Darshan. Just a second. Illustration number 5 you are asking. Let me see. What you are asking in this illustration, it's very simple. Only the payment made for land will not be allowed as deduction. Everything else will be allowed as deduction. We have discussed this illustration already. So if there is a confusion any point, then you can ask. Do not ask the whole illustration because we have already discussed. You can go back to the last session class, scroll back and see the solution what I have explained. If there is any technical problem or any point you are not understanding, then you can ask me. Okay, it's a very simple question. Exceed on sale taxable होगा ना sir? Khushi is asking. Exceed the selling price, if it exceed, अगर वो exceed करता है cost से खुशी, तो उस part पर हम capital gain calculate करेंगे, वो भी in first case only. अगर वो सेकंड केस है अदर बिजनेस का तो उसमें हमेशा कैपिटल गेन लगेगा या नहीं, वो आपको कैपिटल गेन के प्रोविजन में पता चलेगा. सो फॉर टाइम बीइंग प्लीज डू नॉट बॉदर अबाउट द कैपिटल गेन ट्रीटमेंट. I am going to teach you the capital gain provisions also. So I am here. Just do not worry. When the time will come, I will let you know how to calculate the capital gain in case of these assets. Okay. So moving on to the notes, and before that, now the time is for MCQs. The MCQs I have prepared for you. So how many of you are ready to give the answer of MCQ? You should have your paper, pen and calculator because a lot of MCQ rating for numerical treatment. So please get ready for the MCQs. I am going to ask you one by one. Please, who are ready for this? Darshan, that note is saying, illustration number 5, only company SSC are entitled to deduction. Section 35 2AB question it is, and it is only applicable for company case, not for any other case. So in respect of in-house research and development expenditure incurred, however, in this case, the SSC is an individual because our question related to individual person, so he can claim deduction for revenue expenditure, capital expenditure, and for any donations also. This is what the note says. Okay. Okay, Keshav is ready for the MCQs. Kushi is ready for MCQs. Bhumika, everybody is ready for the MCQs. So here is the first MCQ. Read it carefully and then only answer. And it's very simple, but it looks like it's a huge question. It's very, very simple. Opening WDV of the block of asset was 15 lakh. During the year, asset was acquired under this block on 15 June 2022, amounting to 10 lakh rupees. One of the assets falling within the block was sold for 5 lakh 50,000 on 14th January 2023. Rate of depreciation is 10%. Calculate the amount of depreciation. Let me tell you an important thing regarding calculation of depreciation. If any asset has been transferred from the block, then always use FIFO method. Always imagine that it has been sold from the opening value firstly. If it has been specifically right in the question, if it has been specifically given in the question that the new asset purchased has been sold, or the specific asset purchased on a specific date has been sold, then the value should reduce from that asset value. Otherwise, always use FIFO method. As in this question, one of the assets falling within the block was sold for rupees 5,50,000. It has not been given that the opening block asset has been sold or a new asset purchased on 15 June has been sold. So we will always apply FIFO. That means 5,50,000 will be reduced firstly from 15 lakh. Then you can claim the depreciation. So what is the answer? I am waiting for your first question answer. Let's see who's going to give me the answer. Okay, Darshan is saying A. Anyone else? I've told you, if not given in question, then always use FIFO method. Like in this question, opening is 15 lakh and purchase asset is 10 lakh and sale is 550. So remaining is 19,50,000. So to calculate depreciation, reduce this value applying FIFO. That means I need to reduce it from this value. So technically we have 9,50,000 value for this and 10 lakh value for the new asset. So this is 19.50. So you can understand it like this also. So what is the correct answer? Okay. Diksha is saying A, Akshay is saying A, Lata is saying C, and Bhumika is saying A. The correct answer is A. That is 1,95,000 because 19,50,000 is the WDV and 10% will be 1,95,000. Moving on to second question. Opening WDV of the block of asset was 25 lakh. During the year, asset was acquired under this block on 11/10/22 amounting to 15 lakh. Also, money payable in respect of asset falling within this block was 38 lakh. Calculate the depreciation. Again, in this question, it has not been given which asset has been sold. So always use the FIFO method. Let me help you regarding that. So opening was 25 lakh. New purchased, always write down whether it's used for more than 180 or less than. In last example, it was purchased in June. So that was technically more than 180. Now it has been purchased on 11th October. That means less than 180. I have told you in the last class also, if the put to use date is not given or any information regarding put to use has not been given, always apply its put to use on the date of purchase. So 15 lakh rupees value asset purchase. That means we have 40 lakh rupees value. And now some asset has been sold for rupees 38 lakh. Again, in question, it has not been given, which has been sold. So these 38 lakh will be reduced using FIFO method. That means 25 lakh will be reduced firstly from this. So the opening WDV value left with 0. And balance 13 lakh will be write off from this value, the asset purchase from on 11th October 2022. So remaining 2 lakh. You can check it out. It's always should be equal. So remaining 2 lakh will be the asset which is used for less than 180 lakh. So now you know which rate we should apply to calculate the depreciation on 2 lakh rupees. Let me see if anybody has given me the answer. So the question number 2 answer, Darshan has said B. Akshay is saying B. The correct answer is exactly B. So we will apply depreciation rate 50% of the normal rate. That would be 5% on value of 2 lakh. So always use FIFO method. Do not try to apply full rate on this, because if you will apply FIFO method, you will come to know that yes, This value has been gone to 0. So remaining 2 lakh belongs to less than 180. And that will apply rate of 5%. So depreciation will be 10,000. Correct answer is option number B. Well done. Those are giving correct answer. Very well done. I appreciate that. Okay, next is question number 3. Adu Limited owns machinery rate 15%. The WDV of which was on 1st April 22 was 30 lakh. Due to fire, entire asset in the block were destroyed and the insurer paid 25 lakh. The eligible depreciation in respect of this machinery should be. Now, let me discuss a very important provision regarding the depreciation, what we did not discuss yet. In case to claim depreciation, if you want to claim depreciation, there is a very important rule. The rule says to claim depreciation under income tax, there should be asset, at least one asset. There should be at least one asset plus value, any value. Both should exist on last day of previous. So if you want to claim depreciation under income tax, then in the block, there should be at least any asset or there must be some value to claim depreciation. If there is no asset but value exists, you cannot claim depreciation, or vice versa. If you have value but no asset, you cannot claim depreciation. If you have asset but no value, still you cannot claim the depreciation. Like this, for example, there is opening WDV of block of asset, for example, 10 lakh. And there is asset A, B, and C exist. Okay. Now we purchased a new asset during previous year, asset D. We purchased asset D for rupees 2 lakh. So now in my block, there are 4 assets, A, B, C, and D. A, B, C belongs to the opening WDV and the asset purchased new, that is asset D. Now, if it is given in question that suppose asset A has been sold for rupees 15 lakh. Only one asset has been sold for rupees 15 lakh. Then what will happen? 10 lakh opening WDV plus 2 and minus 15. We cannot reduce 15. We reduce only up to 12 lakh rupees. So now you can see that there is asset remaining in the block. Asset B, C, and D still in the block. But there is no value. So asset exists, but value does not exist. So we cannot claim depreciation in this case. Understood? Suppose asset A has been sold. Suppose now whole block of assets sold. All asset has been sold. A, B, C, and D. All 4 asset has been sold for rupees 11 lakh. All 4 asset has been sold for rupees 11 lakh. So what will happen now? 10 lakh opening plus 2 lakh new asset sold for 11 lakh. So remaining value is 1. Now in the block value exists. But does asset exist? No, because whole block has been sold. So still there is value remaining 1 lakh, but there is practically no asset in the block. So again, we cannot claim depreciation. So in this first example, there is asset but no value. So we cannot claim depreciation. In the second example, there is value exists, but there is no asset. So still we cannot claim the depreciation. Again, if there is third case, for example, assets sold A and D. These has been sold for rupees 9 lakh. So now opening is 10, purchase is D for 2 lakh and sold 9 lakh. So now remaining will be 3 lakh. So now we have asset B and C and value also. So we have asset also, we have value also. Now you can claim the depreciation only in this case. So that's a very important case because in this situation, a lot of students get confused. This is very dangerous. Because in this case, if there is no value, you automatically cannot claim depreciation practically. But if in this case, generally value exists and we forgot. We generally forget that there is no asset remaining because we have sold all the asset. So practically we use calculator and we apply dep rate on the value. So that is very dangerous. So you always remember if there is no asset left in the block, then you cannot claim the depreciation. So there should be asset as well as value. Both should exist in the block to claim depreciation under income tax. This is the question regarding that. That's why I discussed you this. So question number 3, now you can see that opening WDV is 30 lakh. Opening is 30 lakh. And there's a fire in the block and the insurance company pays 25 lakh rupees and the entire block was destroyed. You can see entire block got destroyed. So now we have 5 lakh rupees value. We have value, but we does not have any asset. So we cannot claim depreciation. The correct answer is D. It's a very, very good question for your practice. Always remember this. This is a mistake which is generally done by students when they solve question. Moving on to next question. Question number 3rd answer was D. Okay, Vishal is, Manisha was saying D. Well done. Terminal depreciation cannot be in this case because it is exclusively applicable only in case of power generating undertaking. Those are using the SLM method. So you cannot apply that. So always when you try to apply any provision, please remember the concept I have told you or you have remembered that. Please always go on that provision. So when you're talking about terminal DAP, first of all, you should understand on which company, on which assessee, on which situation it is applicable. So it is exclusively for power generating undertaking using SLM method. So there is no block concept applicable due to SLM method. So this cannot be applicable. So do not put your provision abruptly. Do not put your provision hypothetically. No, you should remember the provision first. Then try to apply it. I always told you, first of all, read the question, then apply the concept or the provision, then only try to solve it. Okay, Mr. Darshan? Okay. Abhay is asking, can be deducted why you all are switching to capital gain concept? How we need to calculate the capital gain, we will discuss it when the capital gain chapter will go. So can we deduct sale against same asset and excess amount transferred to capital gain? Right now, you should understand only one thing. How to calculate the depreciation or block value. Do not ask the capital gain queries because it's very difficult to teach you right now because we did not discuss any concept of capital gain right now. So are you able to understand how to claim depreciation in that? If it is yes, then we are done. Do not ask capital gain. It's just like the way that you are going to ask me the question regarding the final syllabus. So we are not still in final. So how can you ask that? So please understand everyone one thing, that if you are able to solve the depreciation, if you are able to calculate the WDV, we are done, we are good. So do not confuse, do not bother about the capital gain. I will teach you when the capital gain provision will come. Okay. So question number 3rd. If there is no value or asset exists, you cannot claim the depreciation. The same question number 3 we just discussed. Okay. Moving on to next question. MCQ question number 4. Swan Private Limited acquired machinery for 5,75,000, which include GST of 75,000. It's very, very simple. Eligible for GST credit. We discussed question number 3. It has been solved. The correct answer was nil. Now the question number 4, it's regarding, it says that we have purchased a machinery for 5,75,000, which include GST. I have told you that if there is any GST or any custom duty for which credit has been availed, that cannot be form part of your cost of the asset, actual cost of the asset. So 75,000 eligible for GST credit out of these 5,75,000. You also took a loan of 3 lakh rupees from a bank for purchase of the machine on which interest was 25,000 till the date of put to use. So kindly calculate the amount of depreciation. I am waiting for your answer. It's a good question. So kindly read it carefully and give me the correct answer. Bhumika was asking, sir, we can claim depreciation on 12. We cannot claim depreciation on 12 in that case. I have told you in the sheet. Out of these 12 lakh, 9 lakh will be deducted because the asset has been sold for 9 lakh. So we can claim depreciation only remaining 3 lakh rupees. Whatever will be the depreciation rate, you can claim that only for on 3 lakh rupees. Okay. So let me see who is able to give the answer for question number 4. Okay. Sankaran is saying D. Andhra Pradesh, Nellore. Okay. Darshan is saying B. Okay. The correct answer is B, not D. How? Let me explain you. We have to finish it fast because we need to moving on to our notes. So 5,75,000 is the value. Out of this 75,000 GST credit will be reduced and any expenses still put to use will be form part of your asset value. So now technically the value to claim depreciation is 5,25,000. Depreciation rate is 15%. That will be 78,750. I hope it is clear. Next is question number 5. This is a simple question, of course, for every one of you. Okay, a lot of you are giving correct answer. It's very good. Even if I'm not able to take your names, do not feel bad. Please, you do your work. Fine, you do your work. You have to give the answer. If I am taking your names or not, it does not matter. Fine, Mr. X has purchased a machinery invoice value 12 lakh. He has made payment of 10 lakh by account pay check, 1 lakh 50,000 through RTGS and 50,000 in cash to the supplier of machine on 15 July 19. You need to tell me only the actual cost of the machine. It's a very simple concept we have discussed in the last class. So please read it carefully and give me answer fast. Okay, somebody is saying, Abe saying C, Akshay is saying A, Vishwatha Reddy is saying C. The correct answer is, of course, C, because anything, if it has been exceeding 10,000 in cash, then that value cannot be part of your actual cost. So 50,000 has been paid in cash. So out of these 12 lakh, 50,000 cannot be the part of your actual cost. So the actual cost will be 11 lakh 50,000. Moving on to next question. A company incurred capital expenditure on scientific research. Land value 5 lakh, building is 10 lakh, equipment 7 lakh. The amount of expenditure eligible for deduction under section 35 would be. You do not need calculator for it. It's very simple. You just need to tell me what amount reduction you can claim under section 35 for scientific research business. Question number 6 answer now I need. Question number 6, correct answer is, of course, B. Well done, very well done, Aditi, Manisha, Darshan, Diksha, Mr. Reddy, and Abhay. And Kriti, it's 17 lakh, of course, because land cannot be the part of your deduction. Next is where the assessee does not himself carry on scientific research but makes contribution to an approved university, college, institution to be used for scientific research related to or unrelated to the business of the assessee. Hence, the amount of deduction from income of business shall be allowed. How much deduction he can claim? What percentage somebody can claim if it is outsourcing his scientific research business activities? We discussed it in last session. It's a very simple question. I believe you all can answer this correctly. The correct answer is, of course, C. 100% you can claim as a deduction. Well done. Very well done, students. Very well done. Question number 8. Mr. Rajan has incurred expenditure of 5 lakh by way of payment of sum to approved scientific research association whose object is undertaking of scientific research. The amount of deduction admissible under section 35 will be, because 5 lakh has been given outsourced for the scientific research, of course, the answer will be C, that is 5 lakh rupees. There's nothing difficult in this. Question number 9. XYZ Limited is engaged in production of textile article. Opening WDV of block is 15 lakh. During the year, plant was acquired under this block on 15/12/2022 for 10 lakh. One of the assets falling within the block was sold for 5,50,000 on 14th January 2023. It is 223. It's not 223. It's 2023. Rate of depreciation is 15%. You need to calculate the depreciation as well as additional depreciation available during the previous year for the block. So we need to calculate DAP as well as additional DAP. Let's see how to calculate. Okay, so you always need to make the format first. It will be really easy for you to solve it. Opening is 15 lakh. Okay. Then we will add new plant and machinery which has been purchased on 15th December is 10 lakh. So this is less than 180 days. And one of the asset has been sold on 14th January 23 for 5,50,000. Okay. So the remaining value will be 15 lakh plus 10 minus 550. So we have 19 lakh 50,000 value. But before claiming depreciation, we should know that which rate will be applicable on which asset. So because of FIFO method, we need to deduct 550 from this. So there will be 9,50,000 remaining on which we can claim depreciation at the rate of 15%. No additional debt because it's an old asset. On this 10 lakh, we can claim 7.5% as normal depreciation and of course 10% as additional depreciation. So the total depreciation will be like this. I have solved it already. Question number 9. On 9,50,000, 15%, that will come 1,42,500. On 10 lakh rupees, 7.5% normal depreciation, that will come 75,000. And 10% additional depreciation, that will come 1 lakh rupees. So total is 3,17,500. The correct answer is option number B. I should not solve it for you. I should give it to you to solve it, but because of short of time, I am helping you to solve it. Okay. So the correct answer for question number 9 is B. Well done, Sudhanshu. Well done, Bhumika. Well done, Diksha. Very nice. Well done, Abhay. Well done, Manisha. Well done, Kavita. Very well done. Okay. So moving on to next, last question. Which of the following is not allowable as deduction section 35 AD for specified businesses? And I know it's easy. It's very easy. Let me see who can You can give me the correct answer for this. Section 35AD, there are some expenses you cannot claim deduction under Section 35AD. So I need to know option A, B, C, D, or E, which is the correct option for that. Okay, somebody has sent me. Abhay is saying E, Darshan is saying E, Aditi is saying E. The correct answer is of course E, because we cannot claim deduction regarding goodwill, land, and financial instruments. So investment in share, security, etc. That means that refer to the investment in financial instruments. So we cannot claim A, B, and C. The correct answer is E. Well done, students. Very well done. So moving on to our notes now. We are on assignment number 2. So I have already taken the query. So now I will take the query about around 8:30 before our break. So till our break, we are going to discuss the provision from where we have left. So assignment number 2. Okay, we have to start from section 35D, that is amortization of preliminary expenditure. What is the meaning of preliminary expenditure? It's a very general word, and you all must have known about this. Preliminary expenditure means those expenses regarding the incorporation of business, and that is technically before commencement of business. Generally, we can claim under trading and profit and loss account only those expenditure which have been post commencement of business. There are some exceptions like scientific research business. There are some exceptions like section 35AD business. But except section 35 AD and scientific research, we can only claim those expenditure under our PGBP head. Those are post commencement of business. There are one more exception. These are preliminary expenditure, because these expenditure nature is like this, that you have to do these expenditure before incorporation of a business, like survey report, drafting of documents, MOA, etc. So these are the expenses you need to incur them only before the commencement of business. So except section 35AD and section 35 and section 35D, technically only those expenditure you can claim in your P&L which are post commencement of business. So I have already made the summary for this section, and the detailed provision is after summary. Generally what we do, we read the detailed provision and then we discuss the summary. But I personally believe that for this section, you need to understand the summary first, and then we will move on to the detailed provision. I can explain this summary also in a very easy manner. So section 35D Section 35D is for preliminary expenditure reduction, and it says that whatever your preliminary expenditure, that we will call actual expenditure. Which kind of expenditure will be included in this? That has to be that is being given in the section. We will discuss like incorporation expenses, drafting of MOA, feasibility report, project report, survey, etc. So there is a specific list. We will discuss it. Okay. So whatever the total of those specific expenditure, we will call them actual expenditure. So those actual expenditure, or we have to take 5% of capital employed. What is the meaning of capital employed? Already been in the section. We will discuss it. Or cost of project. We are discussing this in case of companies. Other than company, there is a separate concept. So if there is a question of a company which have done preliminary expenditure, that is before commencement of business, then how we will find the deduction section 35D? We need to take the actual expenditure total, or we need to compare it with the capital employed or cost of project, whichever is higher. That higher value, whichever is higher, we need to take the 5% of that higher value. For example, in the question, capital employed is 50 lakh and this is 60 lakh. And we need to take 60 lakh, 5% over here. That means 3 lakh. An actual expenditure, for example, it is in question 2,50,000. Assume The lower of these two will be your deduction in respect of preliminary expenditure. That means 2,50,000. But we cannot claim the full value in the same year. We can claim 1/5 in the previous year only. So that will be written off in 5 years. We can say 20% or 1/5 of the allowed deduction can be claimed. In our current year income tax profit. So expenses as a deduction will be claimed only 1/5 of eligible expenditure. So if it is not a company, in case of company, this provision applicable. If it is not a company, then same provision will be applicable except capital employed. In that case, there is no higher. It just you need to take 5% of cost of project or actual expenditure, whichever is lower. So in case of company or other than company, only there is a one difference. We need to calculate capital employed or cost of project. We need to take higher of them, and that higher 5% value need to take for the comparison. But if there is not a company case, other than company case, then we will take only 5% of cost of project, because in case of company, only there is capital employed concept applicable. Okay. Now moving on to our summary, and then we will move on to the detailed provision regarding it. Summary is exactly the same what I've just explained to you in the diagram, where in an Indian company, this deduction is not applicable for foreign company or resident non-corporate associates. So either you are the Indian company, you can claim it, and if you are other than a company, you should be a resident. Non-resident still cannot claim it. So a foreign company cannot claim it. Non-resident individual, HUF, partnership, etc., they even cannot claim it. Incurs any expenditure before commencement. Obviously, it's preliminary expenditure. It should be before commencement of business or extension of a new industrial undertaking. He shall be allowed deduction as follows. Period of deduction is 1/5 for every year from the commencement of business. So we can claim it 1/5 in every year. We can claim 1/5. That means 20% every year of the eligible amount. Expenses, that is actual expenditure. So these 5 expenses generally included for calculating the actual expenditure value. The aggregate of these 5 expenditure will be taken in place of actual expenditure. That is preparation of feasibility report, project report by himself or by approved agency. Market survey for business, engineering services by himself or agency. Legal charges for drafting any agreement, MOA, AOA, printing of MOA, AOA, prospectus, etc. Legal fees for registering the company in case of shares and debenture issue, underwriting commission, brokerage, drafting and printing of prospectus, etc. So you can see generally those expenditures are actual expenditure, which is generally incurred before commencement of undertaking or extension of an undertaking. The total of these expenditure will be called actual expenditure. So what is actual expenditure? From point number A to E, the aggregate of those will be called actual expenditure. We need to compare it to 5% of higher of capital employed or cost of project. This is applicable in case of company. And if it is not a company, that only 5% of cost of project will be compared to actual expenditure. Lower will be allowed as reduction, and that is also can be claimed 1/5 every year. In case of transfer, if you transfer your Indian company under amalgamation or demerger, the remaining year deduction, for example, 1 lakh is your eligible amount, or we can say in the example I saw in the sheet, 2,50,000 was the amount. 1/5 is 50,000 every year you can claim as a deduction. After 2 years of claiming deduction, your unit has been amalgamated or demerged. So remaining 3 years deduction can be claimed by the new company that is amalgamating or resulting company. Deduction only available if the accounts has been done audited by a chartered accountant. Okay. Now this is the detailed provision regarding nature of expenditure. You all know now applicable into Indian company or non-corporate assets. Now it will be really easy to understand the provision in detail because I have already discussed the summary with you. Amount eligible production will be allowed as deduction out of in the current year in the next 4 years. That means total 5 years. 1 year is your previous year in which deduction will start, and the remaining 4 years also. So total deduction time duration is of course 5 years. That is 20%. The expenses, feasibility report, project report, market survey, etc. And for company, it's like MOA, AOA, prospectus, etc. also will be included. We already discussed these expenses above. Now, overall limit is maximum 5% of cost of project or capital employed in case of company. In other case, only 5% of cost of project. This is the diagram also in the study. So I have already copied it. Meaning of cost of project, you can go through this provision. For time being, I can tell you what is the total of your fixed assets as shown on the last day of the previous year. That means 31st March 2023 we are talking about. So the actual cost of the fixed asset on the last day of the previous year. So in short, we can say the fixed asset value on 31st March 23 will be called your cost of project in the case of a new business. And this is for extension of the business or setting up of a new unit. Same thing, total fixed asset value on 31st March 2023. In the most of the cases, it will be given in question. The cost of project and capital employed will be given in a question. Okay. The capital employed means your capital employed includes the total of share capital, debentures, and long-term borrowings. Like we can say, if you, from the liability side, if you reduce only current liabilities, the remaining will be your capital employed. This is the definition. You can read it, of course, from here. What is the meaning of long-term borrowing? That has also been given. Audit of account is mandatory in certain cases. The date of audit of account, that is 31st October of the relevant previous assessment year. The date of filing of return. The date of audit of account is 30th September. So for assessment year 23-24, 30th September is the date of audit and the return filing date is 31st of October. If this deduction has been claimed in regard of this expenditure, you cannot claim this expenditure anywhere under the Act. And this is the universal provision in all the cases under income tax, that no income can be taxable twice, no deduction can be claimed twice. Now, the next section is very easy. Amortization of expenditure incurred under voluntarily retirement scheme under section 35 DDA. Voluntary retirement scheme, you must have gone through this provision under your salary chapter. So if employer provides voluntary retirement scheme and if some employee opted for it, then the payment made by the employer under this scheme can be claimed as deduction under section 35 DDA by the employer. This section applied to an assessee who has incurred expenditure in any previous year. Assessee means employer, of course, in the form of payment to any employee in connection with his voluntary retirement. Amount of deduction is almost like section 35D, that is 1/5 every year. So if I am an employer, I paid voluntary retirement payment to my employee 10 lakh rupees in previous year. Then I can claim 20%, that means 1/5 every year, 2 lakh rupees every year as a deduction. If those expenditure reduction has been claimed over here, you cannot claim it anywhere else. Other deduction, section 36. So we discussed about section 30 regarding the deduction for building, then for plant and machinery, section 31. Then section 32 is for depreciation, terminal depreciation, additional depreciation, balancing charge, etc. Then we discussed the provision regarding scientific research asset, section 35, then 35 AD we discussed. After that, we discussed today this provision regarding section 35D, film expenditure and retirement scheme. Now, there are some other expenditure also for which a specific individual section has not been made. A general section, other deduction has been prepared and there are multiple deduction you can claim regarding multiple amount. For other section, you can see there are specific sections has been framed for some specific deduction, whether it's for depreciation, unabsorbed depreciation, terminal depreciation, etc. But other deduction, as it says, there are certain other deduction, no specific section, but it has been divided into specific point under section 36. We are having almost 12 deduction under this section. We will be reading insurance premium for stock store, that means business stock stores. If you have insured it, then the insurance premium can be claimed as deduction. Health insurance premium for employees. If the employer paid health insurance premium under group insurance plan other than cash mode, then he can claim deduction for his employee health insurance premium. Bonus commission, if it has been paid, can claim as deduction. Interest on capital borrowed, if you have taken any borrowing for capital expenditure, for capital asset, up to put to use, that is going to be capitalized. After put to use, it's going to be allowed as revenue expenditure. Discount on zero coupon bond. If you have issued zero coupon bond and any discount has been provided on it, then that discount can be claimed as deduction in the proportionate number of years. If the coupon, if the bond life is 4 years and discount is 1 lakh rupees, then you can claim 1/4 every year, like 25,000 rupees deduction of such discount. Contribution to provident and other fund. If employer paid any contribution for employee in any provident fund up to a certain date, then that deduction can be claimed by the employer. Employer contribution to employee pension scheme. The same concept is applicable for pension scheme contribution. The 8th point is amount received by employer from employer's contribution. This I will explain in detail when we will discussing this in this format, because it's like amount received claiming as deduction. So it's slightly confusing in reading. Then how amount received is a deduction. So I will explain it to you. Bad debts, if it has been write-off, you can claim it, is it as a business deduction. Expenditure on family planning. This deduction is only available to a company. If there's a company who incur any expenditure on family planning of employee or for his staff, then revenue expenditure is fully allowed. And if it's a capital expenditure, then it need to be write-off in certain years. Reduction of STT, that is security transaction tax. If share trading is your business, then STT can be claimed as your business expenditure. Again, reduction of CTT, commodity transaction tax. If this is also in the nature of your business, then this CTT can claim as your business deduction. These are 12 deductions. We are going to discuss it one by one, but these are very easy because they do not have a huge provision regarding itself. First is insurance premium paid for stores, stock, etc. It's very simple. If insurance policy has been taken out against risk, damage, or destruction of the stock or stores of the business, then you can claim that premium as your deduction. The clause seek to allow deduction if you take health insurance premium for your employees and payment has been made other than cash, then the premium deduction can be claimed by employer. The clause seeks to allow a deduction to an employer in respect of premium paid by him by any mode of payment other than cash to effect or to keep in force an insurance on the health of his employees. According with a scheme by General Insurance Corporation or any other insurance company. Bonus or commission, these are deductible in full, provided the sum paid to the employee as bonus or commission shall not be payable to them as a profit or dividend. If anything you are paying as a part of profit or dividend, that cannot be claimed as a deduction. So anything which is paid before calculation of profit can be claimed as expenditure. Anything which is being paid on the basis of profit or as a dividend, that is appropriation of profit, that cannot be claimed as deduction. So if bonus commission is based on profit, that cannot be claimed as deduction. But if a bonus or commission is paid on some achieving a sales target, etc., that can be claimed as deduction. Okay, it's a part, of course, your salary. Interest on borrowed capital, it's a quite huge provision of a page, but it does not explain a much thing. It says deduction of interest is allowed in respect of capital borrowed. We all know that any interest has been paid for capital asset will form part of that asset till put to use. You can claim depreciation. After that, you can claim deduction. So it's very simple. You can go through it. I've already marked the important line that till the date on which asset was first put to use shall not be allowed as a deduction. It will not be a revenue expenditure. It should be the part of your asset and claim depreciation. After the put to use, you cannot capitalize the interest part into the cost of the asset. Zero coupon bond, we discussed that if there is any discount on zero coupon bond, that can be claimed as deduction on pro rata basis, proportionate basis. Okay. Contribution to provident fund or any approved fund. So if any employer makes contribution to the employees recognized provident fund, approved superannuation fund, etc., that can be claimed as deduction by the employer. Employer's contribution to the account of the employee under pension scheme referred to in section 80 CCD. Section 36(1) 4th, to provide that the employer's contribution to the account of an employee under a pension scheme as referred to in section 80 CCD would be allowed as deduction while computing his business income. Our deduction would be restricted to 10% of salary of the employee in the previous year. So the amount you contribute in that fund or 10% of salary, whichever is lower, can be claimed as deduction. Salary means for this purpose includes dearness allowance if as per terms of employment, but exclude all other allowances and perquisites. How it is going to happen? There is a solved example for it, so do not bother. Ex-limited contribute 20% of basic salary to the account of each employee under a pension scheme referred to in section 80 CCD. Dearness allowance is 40% of his basic and it forms part of pay of the employee. The salary is 10 lakh rupees. So I can solve this over here only. It's very simple to solve. So because salary amount is given 10 lakh, basic salary, and DA is 40%, which is part of the terms of employment. That means 4 lakh. So 14 lakh is the salary eligible for deduction. But the provisions say he contribute 20% of basic salary as deduction. That means this. So he contribute 20% of this. That means his actual contribution is 2 lakh rupees. But we can take only 10% of salary as deduction. So 10% of 14 lakh will be 1.4 lakh. And whichever is lower can be claimed as deduction under section 36(1) 4A. Here is a solution for all of you. You can see basic salary 10 lakh, DA is 4 lakh. So eligible salary for deduction is 14 lakh. Actually, he is contributing 20% of basic salary. That is 2 lakh. But we can claim maximum 10% of 14 lakh or 2 lakh. That means whichever is lower, that is 1,40,000 can be claimed as deduction. And if he has claimed 2 lakh, then remaining 60,000 will be disallowed. If he has claimed 2 lakh rupees, then he is eligible to claim only 1,40,000. So he need to disallow 60,000. So I told you in the first session, this 60,000, what we will do with this? Whatever is the net profit as per accounting, we need to add back 60,000 in that. So do not bother about it. We will solve the full questions after the provision we will complete of PGBP, and you will learn how things need to be added back or deduction. Next is amount received by an assessee or employer as contribution. So that is the point number 8. I was telling you that because it was written in that amount received from employee will be allowed as deduction. So that is a controversial word, but this is something else. Let me show you how. So that point number 8 says, if any contribution received from employee, for example, employee paid 10 lakh rupees for contribution. So that will be allowed as deduction. So any amount received from employee will be allowed as deduction. It seems quite difficult to understand. We might get confused that employer is receiving 10 lakh rupees. Employer is receiving 10 lakh rupees. So how the receipt can be claimed as deduction? So that is not the case exactly. The story behind this is this. It says, when employer receive contribution from employee, then it will be shown in employer profit and trading and profit and loss account under receipt. That will be by contribution from employee. So this 10 lakh will be shown as his income part. Exactly. That will be showing under his receipt. But the concept says that whatever amount you have received from employee for his contribution, that means this 10 lakh need to deposit Employer receive it or deduct it from employee salary, but employer has the responsibility. Employer need to deposit that amount to government fund, for which employee technically paid this 10 lakh rupees to the employer, or employer deducted from its salary. And why he deducted from its salary? As per government norms, a certain amount should be deposited to the government fund for the welfare of employee. So employer firstly received these 10 lakh rupees from employee, and when he received, it becomes his income under the credit side of his trading in P&L account. And he need to deposit this amount up to a specified date, up to, we call it, due date of that fund. So it does not mean that this 10 lakh is employer income. Income tax says whatever amount you will receive for deposit in the specified fund need to be treated under your credit side. But you need to deposit it up to a certain date. That is called due date of that fund. And if employer deposited, suppose he deposited it, then this 10 lakh will again claimed as a deduction in the debit side. So effect will be nil. This 10 lakh, when you receive from employee, it will be in your credit side. And if you deposit it, then it will be reduced from your, it will be claimed as deduction. So automatically the effect will be nil. But what if the employer was not able to deposit it till the specified due date? So if he was not able to deposit, then he cannot claim this deduction. So that means this 10 lakh will be included in his net profit. You understand that? That this 10 lakh is not his income. No. He still need to deposit it to the government fund. But if he delayed in that, then deduction cannot be claimed. And what will be the consequences? Because if net profit was 50 lakh, this 10 lakh made it 10 lakh plus. And if he deposit, 10 lakh deducted. So net profit will remain 50 lakh. But if the employer was not able to deposit it till the due date, then this deduction will lapse. So now the profit will be 60 lakhs. So he need to pay tax on 10 lakh rupees, which is not employer income. Remember this. If he does not deposit it up to the due date, that does not mean he need not to deposit. He need to deposit it after later on. He cannot keep that amount with himself. Otherwise, penalty will be imposed upon him also. So he will deposit that amount either up to the due date or later. So if he deposited up to due date, then this 10 lakh will be allowed as deduction. So first of 10 lakh will be added into his income and it will be reduced. So effect will be nil. But if he was not able to deposit it till the due date of that fund, then addition will be done 10 lakh, but deduction cannot be claimed. So upon that 10 lakh, he needs to pay tax by himself, which is technically is not his income, because later on he need to deposit this 10 lakh. So this is the kind of restriction, or you can say kind of penalty department imposed. So due to this effect, employer will always deposit this 10 lakh before the due date, because he know that if he did not deposit it up to the due date, then he needs to pay tax on 10 lakh, even which that 10 lakh is not his income. So that is the whole story of this concept. So now you will not get confused that why this income is treated as deduction. So amount received by an assessee employer as contribution from his employee toward their welfare fund to be allowed only if such amount is credited on or before due date under the relevant act. Credited means that amount has been deposited to that fund on or before the due date under the relevant act. The due date will be given in question. Do not worry about it. So if in question it has been written that 10 lakh has been deposited up to due date, you can claim the deduction. And if it says it does not deposited up to the due date, you cannot claim the deduction. It's a simple provision. Section 36(1)(5)(a) and section 57(1)(a) provide that deduction in respect of sum received by the taxpayer as contribution from his employee toward any welfare fund of such employee will be allowed only if such sum is credited, that means deposited by the taxpayer to the employee's account in the relevant fund on or before the due date. On or before due date will be given in the question. Bad debts concept is very, very easy. These can be claimed as deduction subject to the following condition. The debt or loan should be in respect of a business which was carried on by SSE during the relevant previous year. The debt should have been taken into account in computing the income of the SSE of the previous year in which such debt is write-off. So the write-off should be done to claim any bad debt deduction. If you have remember, if any of you have remember, in the first session when I taught you the format, in that format in the debit side, I have write down provision for bad debts and I have disallowed it. I have added back because of this provision. This is the bad debt concept which says that the bad debt can be only treated as a deduction if it has been written off. So if there is a provision or reserve for bad debt, we cannot claim a deduction due to this concept. Okay. Expense on family planning by a company, any expenditure of revenue nature, bona fide incurred by a company for the purpose of promoting family planning amongst its employee will be allowed as deduction. The important thing is this deduction is only can be claimed by a company. If a partnership firm, proprietorship done this expenditure, they cannot claim the deduction. They will not form part of their deduction provisions. If it is a capital nature, 1/5 of every year can be claimed as a deduction. This deduction only to companies and not to other assessee. Okay. The capital expenditure on promoting family planning will be treated in the same way as capital expenditure for scientific research for the purpose of dealing with the profit or loss on the sale of transfer of the asset. So as we discussed the provision regarding sale of scientific research asset, if it is given in question, that is sale of family planning asset, the same concept will be applicable. Okay. Reduction of STT will be allowed as deduction if you are dealing in security and if there is your business income. If that is not as your business income, that is your capital gain, that is your capital asset, then the treatment will be under capital gain chapter. Same in case of commodities transaction tax. That was section 36 we discussed. Till now, from section 30, we are discussing the deductions. On a section 28, there was charging section. 29 says the deduction can be claimed, and from section 30 to 36. In the all section from section 30 to 36, there is a similarity between these provisions. Similarity is this, that section 30 to 35, every section is for some specific deduction, as we discussed. Okay. And section 36, there is almost 12 deduction for different kind of expenses. And again, these expenses are specified expenses. These are specifically given that CDT, STT, then bad debts provision. So these are technically specific provision for which you can claim deduction. But what if there is a new expenses came for which we did not read any provision yet, like office expenditure? We did not read anything. We did not read any expenditure regarding office expenditure from section 30 to 36. Same. Stationery expenses. Same. Any bonus or commission paid to agent, not to employee. Employee will be fall in the salary category. Refreshment expenditure, electricity expenditure, telephone expenditure, traveling expenditure for business, gift to clients, sales promotion expenditure, advertisement expenditure. So we did not read anything regarding those expenditure also, which is a very important part of course, which is very important part of business expenditure. But there is no concept regarding these expenditure we have discussed yet. So department understood that if they try to make separate provision for all those expenditure, so there will be never-ending list. There will be a never-ending list because there are multiple kind of expenditure with different nature in different business. For profession, these will be different. For businesses, manufacturing, they will be different, etc., etc. So, department made a residuary expenditure section 37. And we can say, like Shakespeare said, with nothing in name. There's nothing in the name. In the same way, this section applied. Like Shakespeare said, naam mein kuch nahi rakha, but technically, this is applicable in section 37. So I personally feel this section name should be Shakespeare section, because technically it talks about this. Section 37 says there is no specific name required. If there is any expenditure, which fulfill the condition of section 37, and listen it carefully, and no other previous section or any other section overrule this. No other section and previous section objected against this. Then that expenditure can be claimed as reduction. Whatever is the name is irrelevant. So listen it carefully. What this section says, section 37 include any expenditure. It says technically, if in short I am explaining you, any expenditure, if it fulfills section 37 conditions, all conditions of section 37, and no other section object or restrict this expenses, then you can claim any expenses as your PGBP deduction. So these two conditions should be fulfilled. Section 37 condition, all conditions should be satisfied, and no other section restricted, objected, overrule it, or cross it. So if this is applicable, then you can claim this expenses by whatever name called as a deduction under your PGBP. Okay, that's a very good provision made by department, because department understood that we cannot make separate provision for each expenditure. So there can be huge list, very huge list which cannot be included under the PGBP head. So revenue expenditure incurred for the purpose of carrying on the business, etc. This is a residuary section under which only business expenditure is allowable, but not the business losses. We are talking about the business expenditure, not the losses. Those arising out of embezzlement, theft, destruction of asset, misappropriation by employee, etc. The deduction is limited only to the amount actually expended and does not extend to a reserve created against the contingent liability. These are the conditions. This is the important point. You need to learn these conditions. These are very general conditions, very simple conditions. The condition number A, the expenditure should not be of the nature described in section 30 to 36. If there is already in section 30 to 36, then we cannot claim the reduction as per section 37. We need to claim reduction as per the specific provision. Because if there is any expenses for which there is specific provision, so specific provision always overrule the general concept. It should have been incurred by the assessee in the accounting year. It should be incurred by the businessman in the accounting year, of course. Third, it should be in respect of business carried on by the assessee, the profit of which are being computed and assessed. It should be for the business which you are carrying on. So, of course, if it is a personal expenditure, you cannot claim it as a deduction. It must have been incurred after the business was set up, because if the expenditure is before setup, those have been already discussed on a section 35D, 35AD, and section 35. It should not be in the nature of any personal expenditure of the assessee. It should have been laid out or expended wholly and exclusively for the purpose of business. It should not be in the nature of capital expenditure, because if it is a capital expenditure, then you can claim depreciation. We are talking about the revenue expenditure. The expenditure should not have been incurred by assessee for any purpose which is an offense or is prohibited by law. So if you are giving bribe to someone and you want to claim that bribe because you are giving bribe for the purpose of business, but still you cannot claim it because it's against law. So if something is violation of law, prohibited law, that expenditure cannot claim as a deduction. Expenditure on keyman insurance policy, if any premium paid by employer or key man insurance policy of any employee, then that expenditure can claim as his business expenditure. For example, section 37(1), what we were discussing about the violation of law. This explanation provides that any expenditure incurred by the assessee for any purpose which is an offense or which is prohibited by law shall not be allowed as deduction or allowance. For example, expenses incurred in providing freebies. Freebies means kind of bribe, etc. to medical practitioner by pharmaceuticals and allied health sector industry. The expenses are in the violation of the provision of Indian Medical Council regulation. Hence, such expenditure are considered to be expenses prohibited by law. You cannot claim these expenditure. Disallowance of CSR expenditures. We all know the corporate social responsibility concept under section 135 of Companies Act. There are certain companies who are fulfilling a certain criteria regarding their net worth, etc. need to expend at least 2% of like a certain amount for the social responsibility purpose. Section 135 of Companies Act empowers CSR expenditure. The question arises whether these CSR expenditure will be allowed as deduction under section 37(1) or not. So the answer is very shocking, and the answer is no. Income tax yet does not recognize CSR expenditure as your business expenditure. So if it given question, that is CSR expenditure done by a company for the social responsibility, but you cannot claim it as a deduction under PGBP. So these are the provision who need to maintain CSR. If your net worth is 500 crore or more, or turnover 1000 crore or more, then almost you need to at least 2% of its average net profit need to be paid as CSR. So that is Companies Act concept. We need not to do anything with it. We need to only know one thing. What is the treatment under income tax? So there is no deduction allowed for CSR. As per Rule 4 of the Companies Rule 2014, the following expenditure are not considered as CSR activity for the purpose of section 135. Under section 37(1), which is regarding income tax, this is our main section, section 37(1) of the Income Tax Act 1961. Only expenditure not covered under section 30 to 36 and incurred wholly and exclusively for the purpose of the business is allowed as a deduction while computing the taxable business income. The issue under consideration is whether CSR expenditure is allowed under section 37 or not. It has been clarified that for the purpose of section 37(1), any expenditure on CSR shall not be deemed to have been incurred for the purpose of business and hence shall not be allowed as deduction under section 37. What is the rationale behind it? What is the object behind it? What is the concept behind it? Please go through once its general concept. The 7 and the last point is advertisement in souvenir of political party. Please read it like this. Any payment to political party for whatever purpose it is, whether for business or not, any payment to political parties cannot be claimed as deduction under PGBP. So even it's an advertisement or any kind of payment to any political party, you cannot claim it as a deduction under PGBP. So kindly go through this provision. These are very simple again. You can just read it like this. Any payment to political party is disallowed. That was second assignment, what we just finished. Let me take the query. If there's any query, then we will discuss it and then we will move on to our new assignment. Our third assignment. This is the new quotation. Our assignment number 3. I have uploaded all the notes on the portal. Okay. So let's see. Rama is asking if take deduction of section 35D, then can we do capitalization of the same, sir? Mr. Rama, if you have claimed section 35D deduction, that is section 35 for premium expenditure, then we are technically making it kind of a deferred revenue expenditure. Deferred revenue concept technically is not in income tax. It is in accounting. So you can see when we write off any expenditure in multiple years. So technically we are doing as per accounting deferred revenue expenditure concept. So section 35D say no, any expenditure which is before commencement, and if those expenditure which is specifically mentioned in section 35D, that is feasibility report, etc., we cannot capitalize it. We cannot capitalize it because specifically section 35D has been made to claim deduction regarding that. Okay. Under section 35D, Sushil Kumar is asking actual expenditure or second 5% of capital employed or cost of project, whichever is higher or lower. No. Do not get confused, Sushil. It's not like this. First of all, you need to take 5% of higher of capital employed or cost of project. Okay. 5% of higher of capital employed or cost of project. For example, capital employed is 20 lakh and cost of project is 15 lakh. So first we need to take higher of those 20 or 15. The higher is 20 lakh. So 5% of 20 lakh will be 10,000 rupees. Now actual expenditure or that 10,000, that means 5%. Now we take the lower of both of it. I explained that with an example in the starting of the concept. You can revise it. You can go back and then you can check it out. Fine. So first of all, 5% of capital employed or cost of project, whichever is higher, you need to take. And then 5% need to compare with the actual expenditure. Then the lower will be taken, and that 1/5 of that lower can claim as deduction. Mrs. Varsha is asking in MCQ if assets sold after 180 days, MCQ 9. Just a second. Let me see what was MCQ 9. If assets sold after 180 days need not to be calculated depreciation. I'm not getting your question, Varsha. It was saying 15 lakh was the opening. During a year, new plant purchase 10 lakh. One of the asset falling within the. It does not matter that you sell the asset under income tax after using 180 or without using for 180. The matter is, if it is not available on the last day of the previous year, if you used any asset under income tax for 364 days in a year, and on the last day of the previous year, you sold it, you transferred it, then automatically that value is going to be reduced from the WDV. The sale value will be reduced. So technically on that value, you cannot claim depreciation. Okay. It's a very interesting concept. Miss Khushi Gupta is asking, sir, income tax में किसी भी income पर double deduction नहीं ले सकते, तो PF की deduction हम salary head में भी तो लेते हैं, तो फिर PGBP में कैसे लेंगे? खुशी मैडम, हम PF की deduction नहीं लेते, हम PF को employee के hand में taxable करते हैं. Understand? Employee के hand में taxable होता है वहां पर. अगर वो 12%, if it exceeding 12%, then that excess percent contribution to RPF is taxable for employee in the employee head as an income. Okay, and we are talking about employer. हम यहाँ employer की बात कर रहे हैं. वहां employee की income में add होता है और वो employee deduction ले लेता है 80C में बाद में employee. और यहाँ किसकी बात कर रहे हैं हम? Employer की. कंसेप्ट ये है कि एक इनकम एक ही पर्सन के लिए दो बार टैक्सेबल नहीं हो सकती. एक इनकम एक ही पर्सन के लिए दो बार टैक्सेबल नहीं होगी, और एक ही एक्सपेंस एक ही पर्सन के लिए दो बार डिडक्शन नहीं लिया जा सकता. सो कंसेप्ट ये है कि डबल टैक्सेशन और डबल डिडक्शन अलाउड नहीं फॉर द सेम पर्सन. बट आप जो बात कर रही हैं उसमें वहां बात एम्प्लॉय की डिडक्शन की हो रही, और यहां पर हम बात एम्प्लॉयर की डिडक्शन की कर रहे हैं. आई होप यू अंडरस्टैंड व्हाट आई जस्ट ट्राई टू make you understand. Okay, so this is our third assignment of PGBP, and quotation is some are destined to succeed and some are determined to succeed. So you have to be determination. You have to determine that you need to be successful in your life, and you are, if you have that determination, nobody can stop. Nobody can stop. So I think result is about to come. Okay, so this is now section 40, deductions not allowed. This is the assignment. After that, very few pages. Assignment 4 will be very small because there's nothing more left. After this third assignment, the most of the important provision will be completed when we will complete our this assignment of 39 pages. After that, assignment 4 is very simple. Maximum theoretical provisions are there. Okay. So section 40, which says deductions not allowed in section 40. So there are some expenses on which no deduction allowed under PGBP head in whatsoever circumstances. So what are these sections? We are going to discuss, and because it's 8:36, okay, one more question is there. Let me see. Sir, in salary deduction is from employee's point of view, but in PGBP is from employer view. Is it correct? Yes, you got it. You got it, Bhumika. Correct. Done. Salaries, everything is from employee point of view. I am employer and Bhumika, you are employee. I am paying you 10 lakh rupees as salary. Assume I'm not giving a 10 rupees even. So assume if I am giving 10 lakh rupees salary to you. So for salary head, it's talking about you. That 10 lakh you receive from me. What is the treatment? Salary head decided according to your point of view. And exactly that 10 lakh rupees treatment, as from my point of view, will be discussed in PGBP head. So everything you have read in salary head, that is from the point of view of receiver, and receiver, that means pay. Pay means employee. And whatever you are studying regarding salary provision, etc., under PGBP head, that is regarding the payer. That means the employer. So that is expenses for employer. That's why we are claiming it as an P&L debit side. And because for employee it's income, so we treat it in his income under the head salary. I hope it's clear, simple. But now the concept must be clear, I guess. Okay, so I have taken all the queries. Let me see if there is any query left. All the queries has been sorted. So let's take a break of 10 minutes, and then we will get back. We will start discussing the provision under section 40. And please, the first point, which is regarding the TDS, and the second point regarding the partners in relation. In this concept, we will discuss the partnership assessment also. So please join it. Do not go anywhere, and please try to take the live class of this. This is one of the most important concept of PGBP, most important deduction, most important expenses concept we are going to discuss. Okay. So we will take a short break of 10 minutes and we'll get back after that. So Mr. Welcome back, everyone. I guess the result did not came yet. From my office, there are 8 results pending today, 4 from final and 4 from intermediate. So I'm also waiting for the result to come. Let's see. Hope best of luck to everyone. I pray for everyone who actually deserving should get clear, of course. Let's see. Okay, there are some query. Let's see. Bhumika is asking, sir, bonus and commission other than dividend is deductible? It says if bonus is commission on depends upon any other factor, not on profit or not like as in dividend, then it is allowed, of course. Yes, if it is paying to the employee, it is allowed. It should not be on the basis of your profit percentage base, or it should not be like in the manner of dividend. Then the bonus and commission is allowed. Okay, so we were on our new topic, that is deduction not allowed. The first one is payment without deduction of TDS on section 40A1 to 40A5, payment to partners exceeding specified limit as per section 40B. Inadmissible deduction, that means those expenses which you cannot claim as a deduction. First one is business disallowance in section 40A1, 40A1A, 40A3, deduction of TDS. Look, TDS is a different concept, completely different concept, and it will be discussing with you in chapter 9, I guess. In that, advanced tax, TDS provisions are there. So we are not here to discuss regarding the TDS concept. What is the TDS, etc.? That is a different chapter concept, but there are certain expenses. What I am telling you, please listen carefully. There are certain expenses on which TDS deduction is mandatory at the time of payment or due, as the case may be. Tax deducted at source. TDS is not any different concept. It's a nature of collection of income tax at the time of earning of that income. Generally, we pay tax in assessment year. In the basic section, you must have read that the previous year income is taxable in assessment year. Correct? But it does not mean that the previous year tax need to be paid only in assessment year. There is certain concept like advanced tax, TDS, and these are part of income tax. So TDS is a kind of an income tax which need to pay on certain incomes at the time of earning. What are those income? How to deduct? What percentage of tax need to pay, etc. This is covered in chapter number 9. So we are not discussing the TDS concept. I am just telling you one thing, that there are certain incomes on which TDS provisions are applicable. Those income in chapter number 9, okay? But there are certain income on which TDS concept applicable. Or we can say there are certain payments. Because we are discussing from the point of view of employer, so we will use the term payment. So there are certain payment on which tax need to be deducted. What kind of expenses these are? How to deduct tax? That is chapter 9 concept. But what we are saying, there are certain expenses on which TDS need to be deducted, and if not deducted, then you cannot claim deduction of that expense in your P&L. Okay, so in this sentence, in this scenario, certain expenses required TDS deduction. What are those expenses? That is not our heading. That is chapter 9 provision. We are just discussing that if there is certain expenses on which TDS required to deduct, and if it is not deducted, then deduction is not allowed, etc. Okay. And this is a very, we can say, if you will read it with theoretical provision only, you might get confused. It's a confusing provision. Nothing is difficult. Let me tell you, nothing is difficult in this world. Everything is easy. Everything is easy. If you want to learn that thing, if you have interest in that. And yes, CA course is difficult because it is important. This is the truth of your life, that anything which is difficult is important, and anything which is important is automatically difficult. So CA course is difficult because that's why it's important in your life. And if it is important, that automatically means it's difficult thing. Nothing is free in this world. So clearing your 12th, 10th is easy. So it's not that important in your life. It is important for your education purpose, but you cannot get a job or etc. after clearing of 12th, etc. Fine. So CA is difficult. That's why it's important, because if you clear it, you will get a very good job, reputation. You can fulfill your dreams. If you are doing IES, it's more difficult. So it is more important. We can say it's more important. That's why it's more difficult. To become Prime Minister of India, it's utmost difficult. That's why it's utmost important. So it's a universal rule. Whatever is important, that is difficult to achieve. And what is difficult to achieve, that is automatically important. So C is difficult. Any chapter is difficult, then it's technically important. And now nothing is difficult. If you have passion to do that, if you have interest to do that, nothing is difficult. Our brain is very, very powerful, very powerful. We generally use 2 to 5% of our brain. And in that 2 to 5%, imagine what we learned from our childhood till our death. Everything. We have stored with the hard disk of unlimited capacity. Not 1 TB, not 10 TB, it's unlimited. You can imagine anything, anytime. You have a RAM, which has no limit. You have a hard disk, which has no limit. You have a processor, which has no limit. But it depends for which purpose you are using it. So if you are using it for your future benefit, that's everything is easy. So that's what I'm saying. Your brain is so powerful. Technically, you can learn every book of this word by word. If you can utilize your full power of brain. There is a English movie also that name Lucy. So if you practically want to see that what our brain can do, if it is working on a certain percentage and growing, and if it's working on 100%, then what we can do, that movie you can see and you can understand how powerful our brain is. The problem is this: we are not utilizing it for the right purpose. Somebody became terrorist and utilizing that brain for destruction. Somebody became a scientist and utilize it for the humanity. Somebody can utilize this to become a chartered accountant. Somebody can utilize it to become a doctor, IAS, anything. So nothing is difficult. Just believe in your brain, believe in yourself. It might happen that you might learn some provision in 30 minutes. Somebody else can learn that provision in 15 minutes. That regarding focus and interest. But it does not mean that you cannot learn it. You do not have that brain to learn it. No. That's a process he or you follow. That's a focus he or you follow. But you cannot say that my brain cannot do that. I cannot do that, because your brain can do anything. You can't even imagine that powerful device you have over here. So if this is working correctly, you can achieve anything. And if this is not working correctly, then you cannot achieve anything. Okay. So that was the moral of today's story. Now moving on to the provision. So I was saying that section 40A provisions are a little confusing if you will go through the theoretical provision. So I'll make a diagram first, and then we will discuss the provision. And I have already told you that I will upload all the diagrams for all the provision once we will complete this session. Okay, PGBP session. Let's move on to the new share. So this is none of our concern to understand on which payment TDS need to deduct. That will be discussed in, of course, your TDS concept. So I'm writing like this: TDS on payments on which TDS need to deduct. That is a chapter 9 concept. So we are over here to discuss expenditure on which TDS need to deduct. if paid to. So there are certain expenses like salary, interest, royalty fees, etc., on which TDS required to be deducted. And if these expenditure we are going to pay to some person, then this TDS concept need to be followed. If paid to. So now diagram will be in 3 parts. If we are paying these expenditure either to a non-resident, then there is separate provision. If we are paying this to a resident who is currently in India, or we are paying this to a resident who is outside India. Clear? So if those payment on which TDS required to be deducted as an employer, and I am paying these payment to either to a non-resident, whether he's in India or outside, does not matter, or to a resident who is in India, or to a resident who is outside India, then the concept says either we are paying him salary. Am I a businessman and I am paying salary to a person who is a non-resident? Then we need to deduct the TDS or other payment like interest, royalty, etc. So either I am paying salary to that person or I am paying other payment like interest, royalty, etc. So because the space is not okay. So either I am paying salary or other. So what we need to do, if I am paying him salary, the provision says that TDS on that salary need to deducted and deposited. That D&D. Short form we will use D&D. So if I am paying salary to a non-resident, then the TDS, how much TDS, etc., that will be discussed in chapter 9. Whatever TDS amount, whatever the TDS amount due or need to deduct on that salary, that should be deducted and deposited up to due date. We will use short form DD. So if I am saying D&D, that means deducted and deposited. And if I am saying DD, that means due date. So due date of fund also, due date of depositing of TDS also. What are the due dates? Again, do not ask because that is chapter 9 concept. So over here, you just need to understand one thing, that if I am a payer and if I am paying salary to a non-resident, then TDS on that salary need to deducted and deposited up to due date of TDS. If it happen, you can claim that salary as your deduction. That means you can claim that salary as your P&L debit side as an expenses. Okay. And if it does not happen, if you do not deducted and deposited that TDS on that salary up to due date of TDS, if it does not happen, that deduction of that salary will be lapsed forever. For example, if I say that I pay a non-resident 1 lakh rupees per month as salary, and out of 12 months, for 10 months, I deposited TDS, deducted and deposited up to due date of TDS. And for 2 months, I did not deducted or deposited, or I deposited late, not up to due date. So only 10 months salary can be claimed as business expenditure in P&L. I have paid him 12 lakh rupees, but under P&L, I can only claim 10 lakh rupees as salary deduction. 2 lakh rupee deduction will be left. It's a very, very dangerous provision. So you have to be very careful when you are paying salary to a non-resident, and you need to remember that deduction only can be claimed if the TDS on that salary will be deducted and deposited both up to due date of TDS. Understood? Okay. Now, second is other payment. If I am paying other than salary to non-resident, then the provision is slightly easy for us. It says now TDS deducted should be deducted and deposited up to due date of ROI, return of income. Due date of ROI, return of income. That is 31st July. If a non-audit case, and if an audit case, that is 31st of October. Okay. What is the ROI date, etc.? That will also be discussing in later chapter. But remember, over here the concept is saying due date of TDS, and over is due date of ROI. That is generally 31st of July or 31st of October. So if you are paying interest, royalty, etc. to a non-resident, then TDS need to be deducted and deposited up to due date of ROI. That means that date might be 31st July 2023 or 31st of October 2023. Depend upon the assessee. For company, for audit case alag, and for other than audit, different cases. So need to deduct and deposit up to due date of ROI. If it happens, yes, then that expense deduction can claim in previous year 22-23. So even if you deposited it after 31st March 23, practically deducted and deposited after 31st March 23. But if you deposit up to this date, due to ROI date, then government give you benefit to claim that expense as your previous year 22-23 expenses. And if no, you was not able to deduct it and deposit it up to due date of ROI, then again there is no worry. Deduction can claim in the year DND. If you are not able, if you are able to deduct it and deposit it till ROI date, you can claim deduction in the same previous year. And if you are not able to claim deduction, you are not able to deduct it and deposit it till ROI date, then still deduction will not lapse like this. In this case, deduction lapse. But in this case, you can claim deduction in the next year or in the year in which you deduct and deposit the TDS for that expenses. For example, you paid 10 lakh rupees royalty to a non-resident. So if the TDS, whatever amount need to be deducted, is deducted up to due date of ROI, then you can claim this 10 lakh rupees previous year 22-23. That means assessment year 23-24 deduction. But if it is not deducted, deposited up to ROI, and you deduct and deposit it in previous year 24-25, you deduct the TDS and deposit in 24-25, then you can claim deduction of this expense in previous year 24-25. So it is not going to lapse. Whenever in the year you are going to deduct and deposit it, you can claim the reduction in that year. Okay. So that is certain confusing provision, but if you read it again, you will find that is not that difficult. If you are paying payment of salary to a non-resident, you have to deduct and deposit up to due date of TDS. If you did it, you can claim the reduction. If you forgot, lapse. Forgot about reduction. You cannot claim it ever. If it is other payment, then TDS deducted deposited up to due date of ROI. You can claim deduction in the same previous year, otherwise in the year in which the TDS is going to be deducted and deposited. If you are paying this payment to a resident, this is very interesting again. If you are paying any payment, that means this provision is applicable for common provision, salary, or any other payment. For non-resident, separate provision. For resident in India, if any payment made to a resident in India, the concept says If TDS deducted and deposited up to due date of ROI. Of course, deduction can claim. In previous year, 22-23 profit and loss account, you can claim deduction. Same is like this. But the interesting part is this. If not, that means you are not able to deduct and deposit the TDS up to due date of ROI. So in that case, a separate benefit has been given because you are a resident and you are in India. So separate benefit has been given in this situation, which says, even if you did not deduct and deposited, still you can claim deduction of 70% of such expense. For example, the expense was 10 lakh rupees and you did not deduct and deposited TDS, then 7 lakh still is going to be allowed as deduction in the same previous 70%. Only 30% will be disallowed. Only 30% will be disallowed for this year. So you can claim 7 lakh as deduction in the same year. And this 30% can also be claimed in the year D&D. So this is also again not going to be less. So even if you are not going to pay deduct TDS of even a single rupees, still that 70% expenses can be claimed as deduction. But remaining 30% will be allowed only in that year in which the whole TDS is going to be deposited. If it is deposited next year, you can claim 3 lakh rupees deduction in next year. If it is after 2 years, you can claim deduction even after 2 years. So that was the provision regarding if payment to a resident in India. Now we have left with the last provision. Resident who is outside India. So if you are a resident and outside India, we do not need to learn any new provision because on him, either you are paying salary or other. So for salary purpose, non-resident salary payment is applicable. Same concept which is for non-resident salary payment is applicable to resident who is outside India. That means if you deduct and deposited up to due date of TDS, then deduction of salary can claim as it will be expired. And for other payments, this concept is applicable. That if TDS deducted and deposited up to due date of ROI, you can claim deduction in the same previous year. If not, you can still claim 70% in the same year or 30% will be disallowed. So for resident outside India, there is no new concept. On salary, the provision of non-resident will be applicable, salary provision. And for other income, the other provision of resident in India, same exactly is going to applicable. Resident outside India is a hybrid case. One concept is taken from non-resident salary, and for other income, the concept is taken from resident in India. I hope it's clear. Now, one special provision also there. It says that if Mr. A needs to pay 10 lakh rupees to Mr. B, who is a resident in India. And this is for royalty income. And Mr. A did not deduct and deposit any TDS till due date of ROI. But suppose Mr. B, so technically 10 lakh rupees cannot be claimed as deduction. That means we can claim 70%, but 30% cannot claim as deduction. The concept says this. But suppose Mr. B, who is the receiver of this income, Mr. B is the payee, receiver of this income, he pay tax on this 10 lakh rupees income on which no TDS has been deducted by the Mr. A. but Mr. B pay tax on this income by himself and file return of income of his income, including this 10 lakh. So if the payer does not able to deduct and deposited any TDS, if payer is not able to deduct and deposit any TDS, but the pay tax on that 10 lakh rupees income on which TDS was not deducted by the payer, and file the income tax return also for that income, then in this case, government will give deduction to the payer automatically. It will assume, for example, the liability of depositing TDS was on Mr. A. But if the liability of tax has been paid by Mr. B and file his return of income, then it will be assumed that TDS deemed to have been paid by Mr. A. So Mr. A can claim deduction of full amount even if he does not deposit and deducted the TDS. So the government was actually interested in receiving the tax upon it, whether in the nature of TDS by Mr. A or whether in the nature of income tax by Mr. B. So if Mr. A was not fulfilling his condition, but Mr. B paid tax on this 10 lakh rupees and file income tax return, then in all the above cases, the reduction of Mr. A will not be less. Reduction can be claimed by Mr. A in all the cases. Okay. So now moving on to the provision, because if we are going to read these provision before this diagram, so it will be quite confusing. But now we will read the provision and I hope that will be easy for you to understand. So if you will see the language is not that clearly said things. It is hidden something. If you say there is no concept which will say that resident outside India concept. So I have written all the summary of this theoretical provision. You should understand the diagram, and then if you read it, you understand that there's some hidden provision which I just explore it in front of you with the help of a diagram. So section 40A, it says any interest, royalty, fees for technical or other sum chargeable to this act which is payable. Now see the provision outside India. So if interest, royalty, fee for technical services is paying outside India, whether you are a resident or whether you are a non-resident. So if you are a resident, that means it is our third point, which is resident outside India concept it was talking. And in India to a non-resident, non-corporate or to a foreign country. So this is first point which we were discussing. So in this, if you can say in A point, it include resident or non-resident, and B point includes in Indian non-resident. But if you, with the help of a summary, if you say, so technically this is applicable to all non-resident and only for those resident, those are outside India, on which tax is deductible. And we are talking about royalty fees for technical services. So as per the diagram, if up to due date of ROI, whether you are a non-resident or you are a resident outside India, deduct and deposited, then in that case, deduction can be claimed. Okay. On which tax is deductible at source under chapter so and so, and such tax has not been deducted on or after deduction has not been paid on or before the due date of filing of return is specified under section 139(1). Then what will happen? It is also provided that where in respect of any such sum, 139(1) is the return filing date. Section 139(1) for time being, let me tell you, is the due date for filing of ROI. So if you are not able to deduct and deposit the tax up to due date of ROI, then deduction can be claimed in the subsequent year. It is also provided that where in respect of any such sum where the tax has been deducted and deposited in the previous year but paid after the due date of filing of return of income, such sum shall be allowed as deduction in computing the income of the previous year in which such tax has been paid. So summary of this point is this: if you paid tax, deducted and deposited up to due date of ROI, that is section 139(1), deduction can be claimed in the previous year 2020. But if it is paid after due date of ROI, deduction can be claimed in the next previous year. In case assessee fails to deduct or whole of any part on any such sum is not deemed as assessee in default. Now the provision which says that if payer was not able to deduct, but payee, but the receiver, the Mr. B, has furnished his return and has taken into account such sum for computing income in such term and has paid tax. So if the payee fulfill the condition, then it has been deemed that the payer has fulfilled all the condition and deduction can be claimed. You can go through it. Now section 40A1A provides that 30% of the sum payable to a resident. If the concept is applicable to a resident only, this 30% benefit is only for a resident pay, on which tax is deducted at source under chapter so and so shall be disallowed if only 30% is disallowed. So we are saying 70% will be allowed, only 30% will be disallowed. Let's see. Okay. Such tax has not been deducted or such tax after deduction has not been paid before due date of ROI. So you can still claim 70% deduction. Only 30% will be disallowed if you do not deduct it and deposit it up to due date of ROI. So when 30% will be allowed a deduction in the year in which you deducted and deposited the whole TDS which was remaining earlier. In case assessee fails, again the same provision. If the payee filed his return, if the payee show that income in his return of income, if the payee paid tax on that income, that it would be deemed that you have fulfilled the condition and the payer can claim such deduction. For example, tax on royalty paid to Mr. A. A resident has been deducting during the previous year 22-23. The same has to be paid by 31st July or 31st October. That is ROI date, as the case may be. Otherwise, 30% of royalty paid would be disallowed in computing income assessment year 23-24. If in respect of such royalty, the tax deducted during the previous year 22-23 has been paid before 31st July October 23, 30% of such royalty will be allowed reduction in the year of payment. Same concept. 40 is talking about salary. If you can see in point number 1, we were not talking about salary. We were just talking about other than salary, like interest, royalty, etc. For salary, the provision is very strict. It says any sum which is chargeable under the head salary, it is payable outside India. If it's payable outside India, that means to a resident or to a non-resident, whether he is in India or outside India. So he is talking about the case 1, salary concept, and in case 3, salary concept, resident outside India. The concept is same. Deduction will not be allowed if the tax has not been paid thereon, not deducted therefrom under chapter so and so. The deduction will be lapsed. For salary, there is no concept of deduction and deposit after due date of ROI, or deduction will be available in next year. That is not given for salary. So if salary payment to a non-resident or to a resident outside India, so if TDS has not been deducted, deposited up to due date of TDS, no deduction will be claimed. And if salary is paid to a resident in India, in that case, that provision 30% will be applicable, because that is for every income. You can see it. That is for interest, and the first one was for royalty, fees, or technical services. And this is for provide that any sum payable to a resident, any sum payable to a resident who is in India. Or in that case, sum payable means whether it's royalty, interest, salary, same provision in that case. So you should at least once or twice revise the diagram we just discussed. I'll upload the notes. There is also a diagram there, but you should go once or twice again, revise the class and revise that diagram once or twice, or take a screenshot of it and make the diagram on your also. So after that, you will automatically understand the provision which is technically hidden in these concepts. And you will find out, yes, these provision in diagram automatically is hidden in these concepts. Okay, the question: students are advised to read chapter 9 on advanced tax, TDS, introduction to tax collection at source before solving this illustration. This illustration number 10, I can make you understand, but illustration number after this, the next illustration after this, that we need to skip because that is completely connected with the TDS provision. Illustration 10 is connected with the provision which we just discussed. So Delta Limited credited the following amounts to account of resident pay. Understand, the pay is a resident in the month of March 23, without deduction of tax at source. What would be the consequences of non-deduction of tax at source by Delta Limited on these amounts during the financial year 22-23, assuming that the resident payee in all the case mentioned below have not paid the tax, if any, which was required to be deducted by Delta Limited. Okay, let's see. Salary to its employee, 12 lakh rupees, and director remuneration, 28,000. So it is paid to a resident payee, and it does not say that he is outside India. So we will assume that resident payee is in India. And for a resident payee who is in India, we are paying salary and we are paying remuneration to him. And there is no TDS has been deducted. So the provision as per the diagram, you can find it out over here. If you'll see, we are paying to a resident who is in India. So that means we are talking about this provision, resident who is in India. So if you're a resident in India, then provision regarding salary and others are same. And it says, if TDS deducted and deposited up to due date of ROI, then deduction is previous year. And if it not, then 30% will be disallowed and 70% will be allowed. And 30% will be allowed in the year of deducted and deposited. So our question says, your question is for this kind of payee who is resident in India and salary as well as other payment also. And he did not deposit any TDS up to due date of ROI. So what will happen? Only 30% will be disallowed and 70% will be allowed as deduction. It's as simple as that. It's a very interesting thing. If you read the provision of TDS, you will feel it's so complicated. But when there will be question in front of you, then for solving purpose, for application of provision, it's very simple. You can see it, it's so simple that we just need to find the exact case, in which case we are falling. If you'll find in which case we are falling, the answer is too easy. So now we can see, because the case is falling in second category person, and we did not deduct or deposit any TDS up to due date of ROI. So deduction will be, of course, 70% and 30% will be disallowed. Would your answer change if Delta Limited has deducted tax on director's remuneration in April 23 at the time of payment and remitted in the same in July? Now if we say, what will be the answer if, first of all, we need to see the first answer. So in the first case, you can read the theoretical provision, and the disallowance is only 30% of salary as well as director remuneration. Now it says, what if director remuneration has been paid before due date of ROI? Because due date of ROI is July or October, and payment has been made in July. So in that case, director remuneration can be fully allowed. The balance 30% will be allowed in that year. 8,400 rupees will be allowed in the previous year, 23-24, as this has been deducted and deposited before due date of ROI. Illustration number 1, we need to skip because it's completely fulfilled with the TDS concept. So we cannot solve it right now. So we need to skip this question. Now section 48(2). It's very simple again. It says any direct tax, that means income tax. Income tax cannot be allowed as deduction. Not its surcharge, not its cess. So concept says that we can only claim those things as a expenditure or deduction which is before calculating profit. So tax has been calculated after we find out the profit, or dividend distributed after we find out the profit. So technically, anything which is based on our profit calculation cannot be claimed as deduction. In simple word, you can learn it like this. All direct taxes will be disallowed as deduction. Any sum paid on account of any rate or tax levied on profit on the basis of or in proportion to the profit and gain of any business or profit. So the tax as well as surcharge as well as cess, all are going to be disallowed. Tax on perquisite on behalf of employee is not deductible. This is about salary provision. If there is any perquisite provided by employer to his employee, and that perquisite is taxable in the hands of employee, and on that taxable value, if employer pay any tax, the taxable value of that perquisite if it is met by employer. For example, there's a perquisite taxable in the hands of employee is 1 lakh rupees, and tax liability on that 1 lakh is 15,000, and that 15,000 also paid by the employer to the employee. Then that 15,000 tax will not be treated as taxable perquisite in the hands of employee, as well as this 15,000 will not be claimed as deduction in the hands of employee. 1 lakh rupees perquisite will be taxable in the hands of employee. Then you can claim deduction of 1 lakh rupees. But if any tax on any perquisite is paid by employer, then that perquisite is exempted in the hands of employee, and the tax, the perquisite of tax, the tax amount on that perquisite will be exempt in the hands of employee, and so on. The tax paid on that perquisite cannot be claimed as deduction in the hands of employer. Please read it. If there is any confusion, I'll solve it. Interest and remuneration to partners, section 40B. Okay, let me take the queries. Kushi is asking, sir, in case of non-resident TDS, which is deducted on salary, the amount of TDS or the whole amount of salary will be taken as deduction. We are talking about that expense on which TDS need to be deducted. If the salary is 1 lakh and TDS required to be deducted 10,000, then all the cases of TDS, we are talking about the expense of 1 lakh. TDS cannot be claimed as deduction, etc., because it's a part of tax. We are talking about that whole amount of expenditure, 1 lakh, or if it's a commission, then we are talking about the commission value. So we are talking about that expenses value, not about that TDS deduction allowed or not. If of rupees 1 lakh rupees salary, TDS is 10,000. Then if you deposit that 10,000, then 1 lakh can claim as deduction. Or if you do not deposit that 10,000, then deduction of 1 lakh cannot be claimed. So in all the section and all the expenses we were talking about under TDS was that expenses value deduction will be claimed or not claimed. Okay. Interest and remuneration to partners, section 40B. So in case of partnership or LLP, the concept for calculating income for LLP and partnership firms are same. We are reading the provision from section 30 till section 37. And earlier before this, section 40A. All are applicable similar, whether you are an individual, HUF, partnership firm, LLP, etc., company. All provisions are same. But in case of partnership firm, there are two separate provisions, which is only applicable for partnership firm. Like if I talk about in case of individual, if you are a proprietor, and if you are taking salary from your business, that salary cannot be treated as your expense, it will be a drawing. So if you are running a proprietary business or you are an individual, and if you are taking salary from your business, that salary is not your expense. That is disallowed expenditure. But if you are running a partnership firm, and then if partners taking salary from that partnership firm, then that salary is allowed to a certain extent as per section 40B. And same in case of interest to partner. If partnership firm paying interest on capital or loan to partners, then a certain percentage of interest is allowed. And same with the salary. If firm pays salary to a partner, a certain amount of salary can be allowed as deduction in case of partnership firm. So we just need to calculate two things, or we need to understand the provisions of interest to partner or just salary to partner. And if we able to understand these two provisions, the partnership firm assessment is done. Okay. So in case of any firm, assessable or such all LLP, both have same concept. The following amounts shall not be deducted in computing the business income. First of all, remuneration to non-working partner, that cannot be claimed as deduction. Only to a working partner, remuneration or salary is allowed. Remuneration to a working partner not authorized by deed. If any remuneration to a working partner, but it is not authorized by deed, still you cannot claim the deduction. If remuneration to a working partner or interest to a working partner authorized by deed, but it's for earlier period. For example, deed has been made on 1st of June. salary will be provided to partners is being mentioned in the deed, and deed has been made from 1st of June 2022. Then you can only allow deduction of those salary, those have been paid from 1st of June or later. But you cannot claim salary or interest of April and May as a deduction because it's before the deed has been made. So any prospective interest, retrospective interest, and salary to partner, that is before the date of deed, is not allowed. Only prospective interest and salary can be claimed. Here's the example, theoretical, you can go through it. Now, these are point number 4 and 5. These are the only two provisions. After that, our assessment of partnership firm will be done. There are only two different situations. There are only two extra deduction which a partnership firm can claim. The first one is interest to any partner in excess of 12% per annum is disallowed. So if partnership firm paying interest on capital or loan to partners, then up to 12% of loan is allowed, and any interest rate which is excess 12% is disallowed. For example, if in question it is given, there is two partner A and B, firm paying 15% interest to Mr. A, that is 20,000 rupees, and 20% interest to Mr. B, that is, for example, 40,000 rupees, and a C partner also there. They are paying 10% interest to him for 50,000 rupees. And asking how much interest should be allowed or disallowed. So interest up to 12% of interest rate will be allowed. So in A case, 20,000 is equal to 15. So what is excess rate? 3%. This amount will be disallowed. That will come. Almost 4,000 will be disallowed and 16,000 will be allowed. Clear? Whatever is disallowed will be added back to the net profit of the partnership firm. Whatever is the net profit of partnership firm, we need to add back disallowed expenditure over here. In the same way, 20% is for 40,000. So that is 40,000 equivalent to 20%. So we are in excess of 8%. That means 16,000 will be disallowed. And this is 10% only, whether it's 50,000, but it is less than 12%. So there is nothing to add back in case of this. So we need to add back 20,000 rupees interest in the net profit of the partnership firm, which is excess of 12% per annum. Okay. Now the salary or remuneration. How much salary or remuneration we can give to a partner? There is a restriction as per section 40B. Any remuneration paid to a working partner authorized by a partnership deed and falling after the date of the deed is excess of the following. You can see in only two sentences, they have covered all the three main things. That remuneration to be a working partner, it should be authorized by a partnership deed, and it should be after the date of the deed. Those three provisions which have been explained over here in point number 1, 2, and 3 has been explained in only two sentences, beautifully drafted by the study material by the ICAI. And it says this much of salary can be claimed as per income tax. This is the maximum limit. This is the maximum limit of salary which can be claimed under income tax. Any excess of this limit will be disallowed on the first 3 lakh of book profit or in case of loss. I believe you must thinking what is the meaning of book profit. So I will explain it to you later. First of all, on the first 3 lakh of book profit or in case of loss, salary or remuneration quantum deduction will be 1,50,000. That's a fixed limit, or 90% of the book profit, whichever is higher. On the balance of book profit, 60% of book profit. Do not bother. What is the meaning of book profit? How we need to calculate this? I have made a summary for this. So that will be solved by me. Relax. Okay. Assessment of partnership firm and LLP. I made the summary. After summary, I'll solve the example. So you understand how to calculate the book profit and the allowable salary also. Assessment of a partnership firm will be done same as per in normal case, except following two additional provision or deductions are available from the profit or gain of the business. First was In case of interest, at the rate 12% will be allowed. Any interest rate excess of 12% will be disallowed. Clear? And in case of salary remuneration to partner 40, the maximum allowable salary as per income tax will be as follows in the same format. On the first of rupees 3 lakh of the book profit, or in case of loss, rupees 150 or 90% of the book profit, whichever is more. On the balance of the book profit, the rate is 60%. So how to calculate the book profit? Here is the format. It is as simple as that. Nothing new we need to do. Calculate net profit as per the provision of income tax. As per section 30 till now, all the provision we have discussed. First of all, you have to calculate the net profit by adding those provisions concept what we have discussed earlier, section 37, 36, each and everything. After you calculate net profit as per other provision of income tax, now you need to do this. Add actual remuneration or salary to partner as debited to P&L account. Full actual salary or remuneration to partner should be added back because that is as per accounting provision. We need to calculate allowable salary as per income tax. So whatever has been given in the trading and P&L account as salary to partner, you need to add back the whole value to find the book profit. And any interest which is in excess of 12%, that means disallowed interest you need to be added back. So net profit as per income tax act, first of all, you need to disallow all the salary which has been mentioned in the trading and P&L account and disallowed interest which is in excess of 12%. After that, we will have our book profit. This is our book profit. Only two extra condition you have to fulfill. You have to add whole salary which is given in P&L account and any interest to partner on loan or capital in excess of 12%. You need to add back that. After that, you will have book profit in your hand. On the basis of that book profit, we will calculate salary like this. Then we will find the final profit or allowable salary. So first of all, we need to understand how to calculate the book profit with the help of a simple example. For example, I am making a simple question. Here is a simple trading and profit and loss account. Fine. It's for a partnership firm. Buy sale. Suppose 50 lakh. Buy closing stock. Suppose 5 lakh. Rent received for a building 1 lakh. Dividend 50,000. Interest 20,000. Profit on sale of asset 4 lakh. Bad debts recovered 1 lakh. This is my credit side, and now this is my debit side to opening stock 3 lakh. To purchase 35 lakh. To salary to staff. This is not partner. This is staff salary. This is 7 lakh. To office expenditure 1 lakh. To royalty. To non-resident on which no TDS deducted and deposited 2 lakh. To provisions 3 lakh. To salary to partner, 2 partners, we take salary 2 lakh, 2 lakh, 4 lakh. To interest, 2 partners, 20%, 30,000, and 15%, 45,000. After that, there is a net profit. We need to calculate it, how much it is. Just give me a minute. I'll calculate for you. 5, 1, 14. So my receipt side is 61,70,000. You can also calculate it. If I'm wrong, please let me correct. So 75,000. So this comes. Debit side is 55,75,000. So the net profit is 5.95. I guess it's correct. Fine. So this has been given in question. And now we need to calculate book profit. So before calculating book profit, we need to find out net profit as per income tax. So I told you in my first session how we need to calculate. We need this profit. This is profit as per accounting provision. And in this profit, we will be adding or subtracting thing. First of all, from credit side, sale is the part of business. Yes. So we will not do anything with the sale. Then closing stock part of business. Yes, rent is the part of income from house property. So we will remove rent from here. That is 1 lakh rupees minus. Dividend also not part of my income business. It's an income from others. So need to remove it. Interest also not part of. Profit on sale of assets. Capital gain provision 4 lakh rupees. Bad debts, because bad debts write-off is the part of business loss. So bad debt recovery will also form part of business income. So I will not do anything with bad debt recovery. This is need to be reduced. Now the expenses part, opening stock is correct. It's part of business expense, purchase, salary staff, office expense. Royalty to a non-resident. We just discussed it that if you are paying royalty to non-resident on which no TDS has been deducted and deposited, and it has not been given that it is directed deposit up to due date of ROI. So that means it is going to be disallowed. Plus 2. Provisions, all provisions are disallowed except the gratuity. This is not for gratuity, so this is disallowed. I told you all the salary to partner to calculate book profit, all the salary to partner need to be added back first. This is 4 lakh need to be added back. And now interest only those part which is exceeding 12%. So let's calculate 30,000 for 20%. So for 8, it's 8,000 is going to be added back. And for 45,000 for 15%, then for 3, it's 9,000. I hope this is a correct calculation. If there's any calculation mistake, please correct me. Now we have done the partners treatment also and the normal PGBP provision what we have read till now, we have applicable that also. So now whatever this value will come, that will be my book profit. Let's calculate how it is, how much it is. 5.95 minus 1 minus 0.5 minus 0.2 minus 4 plus 2, 3, 4, 0.08, 0.09. So according to me, it's 9,42,000 is my book profit. Is there any calculation mistake? Please correct me. Okay. So now book profit is 9,42,000. Now the provision says salary for income tax purposes up to 3 lakh of book profit. Out of this 9,42,000 up to 3 lakh of book profit, it will be 1,50,000, which is a fixed limit, or 90% of book profit. It's not 9,42,000 90%. In this range, we are taking 3 lakh as a book profit. So 90% of this 3 lakh, that will come 2,70,000. So technically, Out of this 9,42,000 book profit, either 1,50,000 or 90% of this value, whichever is, remember, higher. So that means 2,70,000. Balance left, out of this 940, 3 lakh used. So balance is 6,42,000. 60% of this value. That will come 3,85,200. So this is maximum remuneration as per income tax. 385,200 plus 270. 6,55,200. So this is the maximum amount of remuneration you can claim under income tax. But for calculating net profit from book profit, we need to deduct salary to partner, because the salary to partner, which was as per accounting 4 lakh, we already added back that. So now we need to find what salary should be allowed. So allowable salary formula is this: income tax or accounting salary, whichever is lower, that is going to be allowed. So as per income tax, you can claim salary 655,200, and as per accounting, the salary is given to both partner is 4 lakh. So whichever is lower is going to be allowable salary in our question, because 655 or 4 lakh, that means 4 lakh will be my allowable salary, and we need to deduct this 4 lakh from our book profit now. So remaining will be my net profit. That means my answer. So examination, if examiner is asking you calculate book profit, then this is your answer. If examiner is saying calculate book profit and maximum remuneration as per income tax, this is your book profit and this is your maximum remuneration as per income tax. If examiner is asking calculate book profit and allowable remuneration, so income tax or as per accounting remuneration, lower is your allowable. And if he is asking calculate net profit of the partnership firm, then first of all, you need to calculate book profit. Then you find out maximum salary as per income tax. Then you need to find lower of income tax and accounting salary. And then whatever is lower need to deduct over here, and you will find your answer of a net profit. So if no clerical mistake in this, no calculation mistake, then the format this should be follow to find out income of a partnership firm. So if there's any query, you can ask me. This is the concept. You can go through it. You can read it. Meaning of book profit, working partner, illustration number 12. I am going to solve it in the next class. You just read the provision, illustration 12 and 13. Both are related to the partnership firm topic. I will solve it for you in the next class. First of all, you need to read the provision, learn them. Okay. So if there is any query, I will take it. Okay. So there is, I guess, no query for now. Please do revise all the provision, please. And in the next session, we will take first of all an MCQ test, and I'll believe that you studying very hard. And this is a profession, you have to give all of it, whatever you have, your focus, your time, your dedication, your sacrifice, etc. And once you are going to give everything to this profession, it will give you back for your next entire life. So have a good day, everyone. All the best for those students who have your examination result awaited. And see you very soon in the next session, that is on 7th of July. So please read the provision twice. That's my advice to make you wise. So, Manishji, can we close the session?